What's happening, Steve-O? Got a fucking whirler for you there, mate. Welcome back to Love for Crypto, Dead. How's it going, guys? Go on, some crypto trader, my man. I've got some fucking Illuminati shit for you here, my friend. This video I've just been watching has been giving me chills. I had to stop watching it. I'm going to give you gracious people the opportunity to watch it alongside me, because it's it's intense shit, mate, trust me. Just wait for the room to fill up a little bit. Probably won't get that many in here, but fuck me, tell you what. I fucking tell you what. You're going to love this shit, people. Gumtree boys bought an XRP from Coinbase today. I don't use Coinbase no more, mate. City of London run the world. These are the... Oh, God, honestly. I'll tell you what, right. We've got 66 people now. I'm just gonna tell you what it is, basically, right. So, one of my friends... you're watching... Simon's actually just messaged me. He's done a live stream with us a couple of times, Simon, watching the Grandmaster. It's the Grandmaster, this. There's a lot of lords from the UK, Mark Carney, the Governor of England, Bank of England, shall I say, and Christine Lagarde telling her faithful narrative story tales of the new global economy. So I'm just going to put it in, I'm just going to do a bit of a running, narrative.
We'll be sending out.
Is that volume good for you guys? If you can let me know. What's the volume like?
We'd be very grateful if you would please take a couple of minutes to complete this, because we'd welcome your feedback.
What's the volume
My
like?
Lords,
Good.
Governor,
Sweet.
Alderman, Sheriff,
Sit the foot back and enjoy this.
Commoner, ladies and gentlemen, please stand and welcome Alderman Sir David Wootton, Madame Christine Lagarde, and the Master of the World Traders Company.
Up a little curve. Shit. Let's see how this happens. There we go, Chris. Well said, my meter. Should be better that for everyone now, that. Andrew, you're smoking crack, mate. It's not going to zero. Crypto trader. That's exactly what I felt like. It's some ritual fucking Illuminati masonry shit, this, mate, honestly. You get that sense of feeling.
May I introduce the Master of the World Traders Company, Dr. Edwina Morton.
Wardens, Sir David, my lords, Governor, Alderman, Sheriff, Chief Commoner, ladies and gentlemen. Welcome everyone to the World Traders Annual Tacitus Lecture. I have the pleasure of being the first Master World Trader to be able to stand here and say not only welcome to the audience in the Guildhall, but also welcome world. This year's lecture is being live streamed, so a particularly warm welcome to any fellow world traders who may be tuning in from around the globe, from New York to New Zealand. For those unfamiliar with the City of London's livery companies, we are the successors to the ancient guilds that were formed to uphold the integrity and standards of...
Have you heard that shit?
We all aimed...
The fucking ancient guilds. Do you know what I mean? Like, this is some fucking deep shit, this, honestly, guys. You need to fucking watch this.
...to do that still, but these days we are mostly educational and charitable organisations. World Traders use the funds we raise, along with the time and talents of our members, to support mostly young people in developing the skills they will need to deal with the outside world. We do not take positions on matters of policy, but we do provide a platform to explore the issues involved in international exchange in all its variety. This annual lecture is merely the grandest of those platforms. But not all is serious reflection in the livery. The World Traders Company motto is commerce and honest friendship.
It's as loud as it goes, that, mate.
A phrase taken from the inaugural address of President Thomas Jefferson. And friendship is key to how we operate. World Traders are the only livery company to hold a Guinness World Record. It was for the most nationalities in a simultaneous popular music sing-along. And since you asked,
I am vaping.
84.
Hodler.
A happy thought for those who enjoy
Cool.
a little
Cheers,
karaoke
Bob.
themselves, including our speaker this evening. But here I trespass on others' turf. It is now my pleasure to invite the Lord Mayor Locum Tenens, Alderman Sir David Wootton, to introduce our distinguished speaker. Sir David was Lord Mayor of the City of London in 2012, the year of the also very friendly London Olympics. Sir David.
Master, Wardens, my Lords,
Fucking hell.
Governor, fellow Alderman, Sheriff, Chief Commoner, ladies and gentlemen. Master, thank you for your most kind introduction. On behalf of the Lord Mayor and the City of London Corporation, it is my pleasure, and that of Sheriff Liz Green, who's with me, to welcome you all to Guildhall for the 32nd Annual Tacitus Lecture. In a fast-moving world which is only becoming faster, it has never been more important to take the time to pause and think, to look at the bigger picture and to try to see where we're going or where we should go. This lecture gives us a wonderful opportunity to do just that. Since 1988, audiences from across the city's financial professional services sector and the wider city community have been drawn to Guildhall to listen to speakers of prestige and distinction from diverse fields concerned with issues affecting world trade. This evening's lecture continues this excellent line. We're delighted to welcome to the city the Managing Director of the International Monetary Fund, Madame Christine Lagarde. Madame Lagarde studied classics, Latin and Greek, at school, and then trained and practiced as a lawyer. So that's 2 good starts. In 2005, she was appointed Minister of State for Foreign Trade in the French government, and then Finance Minister in 2007, the first woman to be Finance Minister of a G7 country. Madame Lagarde is enjoying her second term as Managing Director of the IMF and is a most influential figure in international business and government circles. The title of Madame Lagarde's lecture is The Financial Sector, Redefining a Broader Sense of Purpose. There is no better place to address such an issue than here in the City of London, the world's largest financial centre and the birthplace of modern financial services. Just as the Industrial Revolution transformed the way financial services operated in the 18th century, the digital revolution is having a similar effect today. As correspondence which once took days now takes seconds, and contracts which once took months now take minutes, businesses worldwide are becoming more efficient, accurate and prosperous. However, just like the Industrial Revolution, today's digital revolution is also having major social effects. As the rate of technological advancement outstrips that of social and educational reform, more and more people are lacking in the skills needed to succeed in the new digital age. This is putting new demands on business across all sectors. Not only to play a more active role in the education and training of their future workforce, but also that of their clients, ensuring that everyone across diverse social communities has the skills to access the services of the digital era. This new social role in education and training is just one way that the digital revolution is beginning to transform the purpose of business and financial services beyond that of profit making. In today's lecture we will hear more of how financial services shall redefine its role to serve the modern society of the 21st century. Thank you to the worshipful company of world traders, and in particular its excellent master, Dr. Edwina Morton, for organising this insightful lecture each year, a major contribution to the life of the city. And thank you to Madame Lagarde for talking to us in the city this evening. We are honoured and delighted that you are here and are all very much looking forward to your lecture. Thank you. Madame Lagarde.
Guys, just before we do go on, honest to God, this is solely about the digital economy. This is the education that is being sprouted and echoed around the world by these globalists. This is the direction we are going. There is no two fucking ways about it anymore. And you want to listen to this shit that comes out of her mouth in a minute. It was today. This has only just happened, Yuan. Today, 28th of February. 113 minutes ago.
Master, Wardens, Sir David, my lords, Governor, Alderman, Sheriff, Chief Commoner, ladies and gentlemen, it is a real pleasure and I'm truly honoured to have been invited to deliver the Tacitus lecture in this magnificent guild hall. I'm also very fortunate tonight to be among friends, including some former colleagues who know that I have a weakness for stories. So let me start with a Hollywood story. As you may know, Disney Studios were recently faced with the challenge of creating a sequel to the original Mary Poppins movie. That movie has delighted all of you, and possibly your children, for more than half a century. The producers of the new film recreated the magical nanny from P.L. Travers' books, but they also featured a new cast of characters, including a villain who could give everybody a good scare. What's a good story without a good scare anyway? That villain, yes, you guessed it, that villain is a sleek banker who is cheating his way to fortune. And in the end, of course, as all good stories would have it, the villain is defeated by a touch of magic. So here is my question. Why is the banker the villain? After all, a healthy economy requires a healthy financial sector that is at the service of people as they pursue better lives for themselves and their children. You might call it everyday's magic of finance, helping families buy a home, save for retirement, helping business access to capital, to support growth and employment, helping ordinary people manage risks and prepare for a rainy day. And that is what most financial professionals actually do on a day-to-day basis with dedication and a sense of pride. And yet, despite these good aspects, the caricature of the bad banker has resonated with audiences since the dawn of civilization. And its latest version, seen by millions of children around the world, is telling us something about the deeply felt sense of unease about the role of finance in today's world. It does not take history, sociology, or religion, let alone magic, to trace most of this most recent frustration back to the global financial crisis, which has left painful economic and psychological scars on millions of people. We know also that many people are angry about the steady drip, drip, drip of financial scandals and misconduct that have occurred all over the world. And indeed, financial globalization has been one of the key drivers of what Theodore Roosevelt called the swollen fortunes of the few. What would be today this new Gilded Age with high economic inequality and low social mobility. On Wall Street, for example, overall compensation levels have been reaching record highs yet again. And there is a similar trend of moving back to pre-crisis pay levels in other financial centers as well. No wonder that growing concerns about finance can be heard across the political spectrum. And not just about the issues of the day, but about the fundamental purpose of the industry. In too many cases, the financial sector has strayed from its original noble purpose, and too often it has worked first for itself, and second to serve people and the economy at large. And surely there must be a better way forward, which brings me to the theme that I would like to discuss tonight. I believe that we can build a better financial sector, one that is safer, more sustainable, and ethically sound. A financial industry with a broader sense of purpose. And that goal is not just morally just, but it is economically right. Why? Because a better financial sector is more important than ever to help deliver what in our 21st century we badly need in many corners of the world. Higher employment, greener growth, and good living standards for all. The key to achieving this goal is to reshape finance into something that is more aligned with societal values and more connected to the interests of all stakeholders, from customers to workers, to shareholders, to local communities, and to future generations. Now, to do this, we need more than just a touch of Mary's famous brolly. So let me propose two questions. First, how can we make the financial system safer to encourage the good and not the bad side of finance? And second, how can the financial sector support long-term growth that is more sustainable and more inclusive? I will try to address these two questions. First, how can we make the system safer? Let me begin with a simple observation. If finance is to become safer and more trustworthy, it will need to harness good innovation, better regulation, and a broader sense of responsibility. So let me start with the good innovation first. Students of history will tell us that these issues have resonated through the ages. For one, it is remarkable just how much influence financial innovation has had on human progress. Think of its instrumental role in the development of writing, of mathematics, of accounting, and probability theory. Consider Chinese paper money introduced in the 9th century, or the 13th century Venetian who eagerly bought prestiti, the first true government bonds. And think of how we can draw the line between the first stock exchanges in Antwerp and Amsterdam, of course the London Stock Exchange, and to our modern investment apps that put the global financial markets at our fingertips. At the same time, history tells us about unsustainable credit booms and speculative bubbles that were driven by bright financial ideas that didn't turn out to be so good. In ancient Rome, in the year 33 before Christ, land prices crashed after noble families took out loans to bet on ever-rising land prices. Ultimately, the government of Emperor Tiberius bailed out the investors by extending 3-year interest-free budgetary loans. Sounds familiar. Sure it was in Rome? And how do we know this? Well, Tacitus himself briefly described this financial crisis in his final works. But this is only one of many examples. In the 17th century tulip mania, it was a new market for future contracts. In the 18th century South Sea bubble, it was the promise of mythical new land. In the 19th and 20th century, it was often new technology, from the railway mania to the dot-com bubble. And of course, in the run-up to the global financial crisis, it was financial engineering that helped drive a frenzy of reckless risk-taking. So when Lehman Brothers collapsed, policymakers were facing what I once referred to as a holy cow moment. The most striking thing for all of us back then, and some of you in the room were highly involved in all that, was actually the incredible fragility of so many advanced economy banks. At their very core, these firms had been weakened by inadequate equity capital, flawed business models, and the blindness of powerful men. A toxic combination that left taxpayers on the hook for massive bank bailouts. Fast forward to the present, and the real question is whether the financial system is safer today. And our short answer, my short answer is, it is safer, but it is not yet safe enough. And there are many of us here who are working hard to make it safe enough. So let me move to better regulation. Over the past decade, countries have worked together to reform the global financial regulations to help rebuild trust and restore financial health. This ambitious effort, in which the IMF, the Financial Stability Board, thank you Mark, the G20 and many others have been involved, has made a substantial difference. Banks have much higher capital and liquidity positions. Big banks are facing tighter regulation and their leverage is lower. Winding down failing banks has become much easier in all major jurisdictions and in many emerging economies. And a big chunk of the derivative market has become significantly more transparent. This is all very good, but it is not good enough. We need further efforts to address the potential dangers of too big to fail as banks become even bigger and more complex. In the United States, for instance, the 5 top banks now hold about 45% of total banking assets, compared with just about 40% in 2007. Meanwhile, leading economists and industry experts have been calling for further increases in equity funding, beyond the current capital requirements, to ensure that banks can withstand a potential storm. This is a call that New Zealand has just recently heard, by the way. Others are not so sure, my own compatriots included, I have to say, because further increases in equity funding might come with negative side effects, such as reduced lending. So they say. So far, the evidence points to relatively small costs of higher capital. But above all, we must be concerned about increasing discrete efforts to roll back some post-crisis regulations. Countries need to resist these pressures. And indeed, they need to push on, because more work and political will are required to fully implement the existing reforms. And as policymakers are still internalizing the lessons from the last crisis, they need to be vigilant about the new risks. For example, we at the IMF have estimated that cyber attacks could potentially lead to net income losses in the global banking system alone of up to $300 billion. Or think of a sharp adjustment in asset prices that could affect the fast-growing shadow banking sector. That part of the financial world comes with many regulatory blind spots that should be addressed. For instance, we believe that countries need to regulate underwriting standards in high-risk debt markets, including leverage loans. Now, of course, making finance safer is not just going to be about innovation and better regulation. It is also going to be about a broader sense of individual and collective responsibility. Responsible behavior has a lot to do with incentives, especially monetary incentives. And there is no question that remuneration policies in the banking sector were driving reckless risk-taking before the financial crisis. As one analyst from this country who writes in orange pinky paper put it, he was going to be here tonight, but he had to give a lecture himself. Employ as little equity as one can, promise a high return on equity, link bonuses to the achievement of this return target in the short term, and ensure that as few as possible of these rewards are clawed back in the event of catastrophe. We know how that story ended. And we know that there is a widely shared perception that those who caused the crisis did not face the consequences, while ordinary people paid a heavy price. And many people actually saw this as the ultimate breach of public trust. So what has changed since then? Well, for one, post-crisis reforms have significantly moved the needle by better aligning individual pay with the health of the firm. If you are a senior banker here in the City of London, 40 to 60% of your variable remuneration is going to be deferred over anywhere between 3 and 7 years. And it can be reduced, cancelled or clawed back in case of poor performance and misconduct. In other words, bankers have more skin in the game. In the UK, senior bankers and traders also have to comply with the so-called senior manager and certification regime, which has increased accountability and is helping firms to set a better tone at the top. And here I would like to commend one of my former IMF colleagues and friends, Minu Shafiq, who in her role as Deputy Governor of the Bank of England under the leadership of Governor Canning, did so much to promote codes of conduct for financial markets. Certainly more can be done, from making clawbacks more consistent across countries, to enhancing the disclosure of disciplinary actions within firms, to creating a global code of conduct. And let us not forget the power of criminal and civil liability. The sleeping lawyer inside myself is waking up now. In major financial centers, we see a more forceful pursuit of individual wrongdoing. But the brunt of legal action, amounting to billions of dollars of fine, which makes the headline, is borne by financial firms, where it is often perceived simply as the cost of doing business. The reality is that even the toughest legal actions, I would put aside probably the criminal ones, because you cannot put a firm in custody. But even the toughest legal sanctions and the smartest compensation and governance rules cannot be substitutes for a strong individual responsibility that is grounded in values and ethics. For it is not just the tone at the top, but the response from the bottom that creates a better and more trusted corporate culture. That is why the financial industry needs what I call an ethics upgrade. Now, what do I mean? For financial professionals, it simply means doing the right things, even when nobody is watching. As one banker, a very senior one, said once to me, he said, "When in doubt, I just wonder what my mother would say." It sounds so simple, and yet it is perhaps the hardest thing to do. We all know that the word credit comes from the Latin root credere, which is trust, which is belief, which is the lifeblood of the financial system. But trust cannot be manufactured, cannot be bought, cannot be mandated. It must be earned through virtuous behavior that is intrinsically motivated, again, done or not done, even when nobody is watching. And here one could draw inspiration from Aristotle, who argued that we are all driven by a sense of purpose. We can achieve our purpose by developing virtues such as justice, courage, self-control, prudence, generosity, and honesty. And Aristotle believed that this was the key to genuine happiness. That spirit can also help achieve a purposeful banking career and a safer and more trusted financial system. But this is not the whole story. Aristotle also believed that individual purpose must always be linked to social purpose, to the common good, which is not tantamount to what a former president of the Fed assumed was right and was not, which was that the addition of the individual purposes would actually equal common good. So this applies to all aspects of our life, including corporations and financial firms. The goal of a corporation cannot be just about its narrow financial interest. It must also encompass a broader sense of responsibility, common responsibility. And it is not surprising, therefore, to see growing debates about the nature of modern corporations and the concept of maximizing shareholders' value. As the British economist Colin Meyer put it, for nearly all of its 2,000-year history, the corporation has combined a public purpose with its commercial activities. It is only over the last 60 years that the idea that profit is the only purpose of business has emerged. I believe that encouraging a broader common responsibility is now more important than ever, not just for today's stakeholders, but for future generations. Which brings me to my second question: how can the financial sector support long-term growth that is more sustainable and that is more inclusive? So let me start with a data point. Over the next 15 years, more than $24 trillion of wealth will be inherited by the millennials. And they are more than twice as likely as other generations to invest in companies or funds that target social or environmental outcomes. The financial industry has seized this opportunity by offering various forms of impact investing, green bonds, and a panoply of fund products that take account of ESG. I haven't told you anything about SDGs yet, it's coming. But ESG, which is environmental, social, and governance issues. Clearly, sustainable investing is booming, but it also points to a deeper issue. Whether you are a banker, a fund manager, a fintech entrepreneur, you are probably wondering how to take a more sustainable approach that is both economically rewarding and ethically right. And I understand that there is a national dialogue which is beginning in this country to actually understand and appreciate how those two goals can be mingled, economically rewarding and ethically right. And I believe that this offers a huge opportunity to redefine the magic of finance to pursue a broader sense of purpose. I know for a fact, because I've discussed that with many of them, that there are equity fund managers who do not believe a word of that and who will pay polite lip service to the principle of this ethically right aspect. But I support the idea that they might be proven wrong. Let's talk about innovation. I've talked about innovation, so why do I talk about innovation again? Because I want to tell you a little bit about Fintech.
Oh, here we go!
The immediate priority should be to foster cutting-edge financial technology. You've heard that before. That means creating Fintech products that are substantially cheaper, more accessible, and more user-friendly. It means serving customers and communities in new and better ways. It also means rethinking the economics of the financial industry itself. Bear with me. In the United States, for example, the unit cost of financial intermediation has remained largely unchanged over the past century, while income from finance has risen and fallen with the value of financial assets. Now that suggests a significant amount of rent extraction. The Fintech response to that is to increase competition, reduce inefficiencies, and provide better value for money to individuals and small businesses. And in doing so, Fintech can help drive an inclusion revolution. In Kenya, in China, mobile payment systems have brought millions of previously unbanked people into the financial system. In Latvia, in Brazil and elsewhere, peer-to-peer lending has opened up new sources of credit for small businesses. And around the world, blockchain enables faster and cheaper transactions, from trading securities to sending money to relative abroad. And this is only the beginning of that inclusion revolution.
The beginning. Fucking get in there,
so
sunshine.
You picked examples in developing countries, emerging markets maybe. No, it applies to advanced economies as well, because we shouldn't forget the 1.5 million people who in this country still have no bank account. We should not forget the 33 million US households who are either unbanked, that's a terrible word actually, it's like deplane, let's say underbanked or do not have bank account, and obviously those numbers are much larger in emerging and developing countries. So there is a huge opportunity to boost financial inclusion, which, as we know, leads to stronger growth and higher employment. And this in turn requires vibrant digital ecosystems such as London, which is home to the biggest cluster of fintech startups in Europe. Now that won't go away, whatever the outcome of what is not talked about tonight. But fintech will not do it alone. We also need better regulation and smarter supervision to ensure that fresh sources of credit do not encourage people to overborrow, and that personal data is protected against prying eyes and criminals. In other words, banking-type fintech services should be subject to banking regulations, especially when it comes to consumer protection. For new firms, this means working with regulators to unlock the immense potential of fintech while managing the risks. This is the goal of what we have called the Bali Fintech Agenda that was launched by the IMF and the World Bank last October. It provides the key principles, including on promoting competition and consumer choices and fighting money laundering or the financing of terrorism. And that Bali Agenda can actually help guide their endeavour and our joint endeavour in the period ahead. And together with a few enlightened, we are going to pursue that agenda. Now, you would probably be fairly disappointed with me if tonight, as I'm talking about this inclusion revolution, I was not going to go a little bit beyond fintech. Because it also encompasses the need for more diverse leadership in finance. And I say this for two reasons. First, greater diversity always sharpens thinking while reducing the potential for groupthink. And second, diversity also leads to more prudence and better decision making. Our own research bears this out. A higher share of women on the board of banks and financial supervision agencies is associated, there are strong correlations actually, with greater financial stability, not causality, correlation, which underpins stronger and more durable growth. And believe me, we have a long way to go. We've done the research, and across the globe, only 2% of banks' CEOs are women, and less than a fifth of bank board members are women. Here in the UK, the Hampton-Alexander Review has been urging the largest listed companies to increase the proportion of women on boards to at least 1/3 by 2020. You are almost there, not quite. Would quotas make a difference? My answer is yes, as long as they're properly designed and implemented. And a good example is that, for those in doubt, is Norway, where over 5 years mandatory quotas supported a 4-fold increase in the proportion of women on corporate boards. And clearly more female leadership is critical, and not just at the top, but as consumer of financial services. Women all over the world are making their voices increasingly heard when it comes to investing their own money. For example, recent surveys show that women are far more likely to engage in sustainable investing than men. And they're driving demand for new products, such as funds targeting gender equality in corporations. That spirit is beautifully captured by the fearless girl statue on Wall Street, which brings me to my final point. I believe that fearless action and fresh ideas are needed more than ever to invest for the global common good. Think about it. Trillions of dollars in private sector investments will need to be mobilized to tackle climate change and to achieve the SDGs, the Sustainable Development Goals, which are aimed at eliminating poverty by 2030, and more than this, making the planet just a better place for our children and their children. These goals, endorsed by the global community, almost, constitute a daunting challenge. But they are also a huge opportunity, especially in the financial sector. Only a few years ago, the financial industry perceived climate risk as a distant threat. Governor Mark Carney famously called it the tragedy of the horizon. But that time horizon has since shifted much closer to the present. We are in February and daffodils are blooming all over the place. Call it normal. Major hurricanes in the Caribbean, wildfires in California, severe floodings in part of the UK. These are just a few but powerful reminders of an economic threat that is already affecting the livelihoods of too many individuals and communities. And there are now growing economic debates over the likely effects of climate change on productivity, on incomes, on financial stability, even on monetary policy, not to mention migration pressures. So what does it mean for the financial sector? It means shifting to a more sustainable form of finance that is grounded in better risk management and longer-term thinking. It also means mobilizing more finance for investment opportunities in people and infrastructure. For example, the IMF recently estimated that the additional spending needed for low-income countries, it's only about 49 of them, to achieve the Sustainable Development Goals in only a few sectors like health, education, and low-carbon infrastructure. So that's only 3 of the 17 principles included in the SDGs. Those 3, would cost about $250 billion per year in 2030. 520 billion. And that gap can only be filled through a combination of public and private resources, from bank lending to project finance to so-called blended finance, which brings together grants, concessional financing, and commercial funding. And nobody is excluding anybody else. It's really for public and private investment to complement each other, not substitute. They must go hand in hand to create the right conditions for investment. And that includes sound economic policies, strong legal frameworks, good governance, and zero tolerance for corruption, whether in the public or in the private sector, paying or receiving. And the Sustainable Development Goals are not just about the developing economies. They're designed to promote global growth that is stronger, fairer, and environmentally friendly. If the Sustainable Development Goals are to deliver on that promise, we will also need to harness the momentum of the sustainable investing sector, which already accounts for $23 trillion or 26% of global assets under management. How might that be done? Fund managers could, for example, launch new investment products that encourage corporations to align their business models with that of the Sustainable Development Goals. They could also work with policymakers to create global standards for sustainability, accounting, and reporting. This would boost transparency and strengthen the credibility of sustainable investment we need to measure and account for. As I said, this is the moment when fearless action is absolutely critical, when fresh ideas can help break the mold, when we join hands to foster the global common good. So let me, by way of conclusion, return to Mary Poppins. Remember the scene where the good banker teaches his children a lesson about purpose. And he argues that they should follow in his footsteps. And he sings the following lines. Now, karaoke, yes, but I don't have the music, so I will not sing tonight. A British bank is run with precision. A British home requires nothing less. Tradition, discipline, and rules must be the tools. Without them, disorder, chaos, moral disintegration. In short, you have a ghastly mess. Well, that is one way of putting it. But the question is whether young people today should consider joining the financial industry. For many of them, the answer comes down to finding a broader sense of purpose. A bit like Mary Poppins herself. The genius of her character is that she's not serving herself first, she's serving others with dignity, with a kind heart, with honesty, and with a wicked sense of humor. Well, some people like to describe the old traditional common sense banker as a sad man in a grey suit. May I suggest that those new bankers of the future be just like her? Dignity, kind heart, honesty, and a wicked sense of humor. That's really what the financial industry could be about. And no better place than London for that wicked sense of humor. Serving others, not yourself. That is the real magic of finance. Thank you.
Right, there's a lot of the same shit that we always fucking hear all the time there from Christine. Financial inclusion, the digital economy. It's always the same fucking shit. Now I know obviously some people in the comments were saying that this is a bit boring, and don't get me wrong, it is, fucking hell, let's go back 18 months ago. I would never dream of watching anything as fucking dry as that in my entire life. But obviously, with our investments and how deeply involved Ripple are with the IMF, specifically Christine Lagarde, we've seen the photographs with Brad Garlinghouse alongside Christine and other IMF members. Listen, this is an educational process here that Christine is doing. She's going round, she's echoing the same globalist bullshit around the world at all these fintechs, the Singapore Fintech Festival, all these other places around the world. This is an educational process now, and these little stories that she's coming out with, they're not stories. This is enactments that the IMF and world central banks will be carrying out moving forward into the future. It's unreal, really, and it's just every single time she's always speaking about fintech. I mean, and let's face it, IMF, the Fintech Advisory Board, Ripple fucking see it. Do you know what I mean? They see it on the Federal Reserve, with the Bank of England, with all the proof of concepts that was carried out in 2017, the relationship going back with the Bank of England as far as 2013. Not to mention the 40 to 50 central banks that Ripple are working alongside. And what do you think that they're all trying to achieve together? It is this world, this globalist world of interconnectedness. People may call it the mark of the beast and all this shit, but I can assure you by 2030, every payment for every newborn child that is born will be tracked from birth to death. It's quite frankly fucking unreal. I'm going to go into the comments here and try and have a little chat, try and do a little Q&A, because I never really do them. But I thought it was definitely worth bringing it to people's attention. I mean, earlier on into the speech, fucking hell, and these people, that she's addressing, that is some fucking Freemason shit right there in front of you. That's not a normal crowd, that she's delivering that speech to. This is the 32nd World Traders speech, and it's the first one to ever be live recorded. All private, all the meetings beforehand have been private. I want to thank Agent Broccoli. Obviously, he led me on to this on Telegram, and I started watching it. I was having a little chat with Chris and Demore And I just thought, fuck me, I'm going to have to put this on for people, because if Christine Lagarde is speaking, she's speaking about the digital economy, and she's speaking about fintech. Yeah, fair enough, she's speaking about equality with men and women, and global warming, you know. And while we're on the fucking topic of global warming, Bitcoin, in my opinion, if it remains on proof of work consensus, is going to zero. There's an urgency around with the G20, with the IMF, around the world of a greener future, a greener, more prosperous future. Do you think, let's just take Bitcoin for example, let's say it is going to act as a store of value equivalent to gold or the world reserve currency. It will be accountable for 20% of the global CO2 emissions being wasted on solving a double spend problem that XRP can do in 3 fucking seconds. Listen, Bitcoin was unbelievable for its technology innovation, the revolution within itself. But look where we stand today, 10 years later down the line. You've got Bitcoin that takes forever to fucking transact. You know, you don't know whether it's going to take fucking 15 minutes or 3 fucking days. You've got XRP that does it in 3 seconds. All these globalists, all they're talking about is financial inclusion, which the Untitled Protocol and XRP can offer, and they're always talking about global warming. Do you think for one fucking second that Bitcoin and its mining consensus and its entire principle is going to be allowed to run wild and allow 20% of the global CO2 emissions that the entire world has been working so drastically hard to decrease, allow it to just all go out the window? Bitcoin's had its fucking day, honestly. I swear to God, it might do well, it might get to 50,000, but I can assure you one thing: if it remains on proof of work and it continues to use mining, I mean, let's look at Bitmain for example. You know, they've laid off 80% of the fucking staff. In China, there's fucking warehouses full of mining rigs that are just not even switched on anymore because the price of Bitcoin has been suppressed to levels where it is no longer profitable to mine. Now, the powers that be can just keep this suppression for as long as they fucking want, and miners will just keep mining and turning over a loss until they are no longer there. And once this happens, you're going to see a drastic reduction in the hash power from across the world from all these mining rigs that are making Bitcoin a super secure fucking system, and it will cost peanuts to collude that system. Bitcoin is it might be going, you know, I'm not trying to be fucking, you know, pessimistic there against Bitcoin, but I fucking heard it all year from Bitcoin maximalists talking about how shit XRP is. So I thought I'd just fucking throw a little bit out there myself anyway. So yeah, on that note, anyway, what's people been saying there? Bitcoin is AOL, XRP is Google. You know, you can't say it better. It's happened numerous times, hasn't it? You know, you've got exactly what you just said. The AOL, you've got Blockbuster and Netflix. You know, you've got Napster and Facebook. You know, it's just a natural cycle. It happens. A new innovation spark is created, and something comes along that is better. And XRP is that. XRP has been broadly adopted by the IMF, by the W3C, by central banks. The Untitled Protocol is going to be the new global bank. It's going to interconnect everybody. It's going to allow financial inclusion to prosper. Bitcoin ain't going to do shit like that, I can assure you. I can assure you that right now. Right, let's have a little look here. We got a sneak peek into the Master Traders Guild. Yeah, Adam, mate, honestly, that was some weird cult shit, that, mate. Honestly, that's not normal. That's not on a normal address. Do you know what I mean? And we're talking about London, you know. It's got deep historic ties to, you know, Rothschild shit, if you want to call it that, the Vaticanist and all that type of stuff. But again, I just thought it would be interesting for some of you. I can understand some of you probably weren't expecting what you was going to be getting, but if anything that involves Christine Lagarde talking about the financial sector, believe me, I'm going to watch that shit. Now, I was speaking to Simon and Jesse before. I'm thinking about doing a little live stream with them not too long after this one. So obviously, if you want to come and tune in and listen to that, I'm going to cut this live stream short at this one because I just want to keep it involved with the IMF. I want to thank you everyone for obviously tuning in. Thanks for all the donations. I was going to try and read them out, but I didn't want to over-speak, obviously, the conference and the speech of what Christine Lagarde was giving. But again, it just shows the direction where we are going. No matter how long this takes, no matter the amount of bullshit that you hear on social media, from the mainstream media, it's all just one big manipulative cycle for people like ourselves to drop our assets, it happened in the internet era in 1995 with Google and Amazon, and I always repeat that phrase, but it's a factuality of life. It was an interesting talk. I truly enjoyed it, to be quite honest with myself. But again, it's just a good little bit of information there. Again, Agent Broccoli, you know what I mean. Thanks very much, obviously, for dropping me that link in Telegram. Do appreciate it. Like for me, obviously, I love this type of stuff now. I mean, I never thought I'd be sat here listening to this type of shit. But I am going to cut the live stream short at this. But do tune in, because I think maybe in the next 10-15 minutes I might potentially be back on, just having a little bit of a laugh, bit of a talk with Simon and Jesse. I might potentially try and get Chris on there if he's got the balls to do so. But if not, anyway, enjoy your night. But I'm going to cut that short at that one.